Hi everyone, how are you? It's Yasser Rodriguez, the founder of Cardia Real Estate Investments here. I'm joined by Matt Picheny, Peter Bartash, and Barak Dunayer. And we're excited, to present a fantastic opportunity here called Granite Woods Commerce Center. Okay, it's going to be in southern New Hampshire. And in the interest of time, I know a lot of you just finished a nice work day today. So out of respect for that, we'll just move efficiently and get through this. This will be recorded, so you'll be able to reference it. Additionally, if you look down, you'll see a question and answers tab. So feel free to ask these questions. They're going to go directly to us, the panelists there. Okay, so I'll turn it over to Matt Picheny, who will kick us off.
All right. Good afternoon or evening, everyone. Very excited to share with you information about Granite Woods Commerce Center. It's a Class A warehouse and distribution facility. Before we get into everything, just a couple of legal disclaimers. I highly recommend you going back to the replay and pausing this and reading this entire thing. But basically, we are doing our best to understand where the market is and where we think things are going to go. There are forward-looking statements such as, we anticipate things, we believe things, but we can't make any guarantees on anything. So we just want to make sure that you're aware of that. And the same thing goes for the finances. We are using projections and forecasts and doing the best to our ability, but we cannot predict the future and we can't make any statements that we can. So we've done a lot of work, taken a very pragmatic approach on this, but those disclaimers are important to share with you. So tonight we're going to go over a quick executive summary. We'll talk about who are the players, who are the four of us, and what are our roles within the group here and our experience. Some highlights on the program, on the investment. Then we'll look at the overall location, an analysis on the market, and an overview of the property. And then we'll get into the finances and then the next steps on how to move forward with this. So very high level. Granite Woods Commerce Center is a 500,000 square foot warehouse and distribution facility located in Hooksett, New Hampshire, that we will be creating. We're going to do it in two phases. The first phase will be 100,000 square feet, and then the remaining 400,000 square feet will be done at a later time. So upon completion, we'll have 500,000 square feet with 67 loading docks, 86 trailer park spaces, 403 car parking spaces, 2 drive-in doors. It's going to be a top-notch facility, but I want to be really clear that this investment today is only for phase one. Once phase one is complete, that is it. There will be an opportunity in most cases to invest in phase two. If there is a phase two, at the end of phase one, we may sell the project or we may refinance and sell it combined with phase two if we think that the market is looking like it's going to be more profitable for investors to do it that way. The project is in a fantastic location. We're going to get into all the details on that, but at a high level, it's only 1,500 feet from I-93, so it's superior highway access. And it's really targeted for large regional logistics, e-commerce, grocery, retail tenants. Okay. We are very close to Manchester Airport. We are very close to Boston Logan Airport. And to date, the sponsors have invested over $17 million to purchase the entire plot, not just for phase one, but for all phases of the project, and done a lot of the pre-development work. So you're getting in on a ground-up construction where a lot of the project, a lot of the risk has been taken off the table because a lot of the work has been done. And Peter will go into some more detail on exactly what's been done to date. But the project budget is almost $21 million. We're looking to raise just about $8.5 million of equity. We're looking to hold the project for 25 months, and we're anticipating a reversion cap rate. So when we sell the property, we're anticipating the cap rate will be 5.5, which is the current prevailing market cap rate today, which would give investors an equity multiple of 1.57, which is an internal rate of return of almost 29%, which is a very strong return. So the key players for the project, you'll see represented on your screen here. I'll introduce myself. I'm Matt Picheny. I'm a full-time real estate investor. I've been investing in real estate for over 20 years. I've been focused primarily in multifamily, where I have a portfolio of almost 5,000 units worth, well, getting close to $700 million. I was a licensed real estate agent, and I have commercial real estate and real estate finance certificates from Boston University, and I've won a bunch of awards and have had a number of successful projects. So that's me. And while I used to live in Boston. I live in New York now. While I was in Boston, I met with Peter through the different real estate circles there, and I've known Peter for a number of years. And I'll pass the baton over to Peter.
Thank you, Matt. Thank you, everyone, for being here this evening. Peter Bartash. I've been in the commercial real estate space for almost 20 years now. I spent a little over 10 years on the architecture side of the business with a focus on early stage business plan formation, asset strategy, refinement, and ultimately pre-development execution for a very large number of institutional sponsors and investors throughout the Northeast and along the Eastern Seaboard here. The product types that I handled ranged anywhere from traditional multifamily to student housing, life sciences, retail, commercial office, and with some industrial as well. I started Common Water Partners together with Caleb Manchester. As a company, we've done more than $500 million worth of full cycle development and close to $300 million in just land development alone, with exits to groups like Greystar, Trammell Crow, and Divco West throughout our life cycle. And Matt and I will talk about one of those deals in particular in a moment here. But my role in these projects is often forming the business strategy, and then ultimately executing on that strategy and leading the execution of that strategy through its full life cycle. So happy to be here and grateful to be teamed up with Matt, Barak, and Yasser. So with that, I'll hand it over to Barak.
Thank you, Peter. I'm Barak Dunayer, also very, very excited to be here with this exceptional team. I have about 26 years of real estate experience. I started a Manhattan brokerage residential firm out of my studio apartment. I grew it to 2 offices and 55 people, and then sold it to one of the biggest brands in New York. Today, I'm a managing partner of the leading real estate team with the operations in New York City and South Florida, having sold over $2 billion in real estate. I've had several entrepreneurial ventures, certified marketer, certified negotiation expert. I have a very extensive list of clientele and investors. And I like this project a lot. We'll talk more about it as we go on, but I'm very happy to be here today. Thank you for having me.
Yeah, and my name is Yasser Rodriguez. I'm actually a full-time practicing cardiac electrophysiologist. So I trained at Brigham and Women's in Boston, so I'm very familiar with the location of this current project. But in addition to that, I got an MBA because of the entrepreneur aspect. And after several years in the single-family home space, which is where most of us kind of get started, I came across a multifamily space. Matt has been a great friend and a mentor as well. And then we did a project together, and looking forward to really participating in this project as well.
Great. So Peter was alluding to a project that he and I partnered together on called 35 Garvey Street. So this is a rendering of it. This project was within a mile of the Encore Casino, which was developed just outside of Boston in a town called Everett, which is adjacent to Boston. And this was actually in an opportunity zone. And we had optioned the land and then went through the entire process of getting all the entitlements. I joined Peter at a lot of presentations where he was talking with the zoning board about, all the different things that they wanted and the public hearings, yada, yada, yada. Project went really well. We were planning to stay involved with the project as it went vertical, but it was also The final approval was actually done via Zoom because COVID had come upon us, and all the everyone kind of put the halts and the brakes on any vertical new development at that time. And we had a loan option that was expiring. So we needed to do something. So we actually ended up moving forward with a sale of the property, and it was very profitable. Within a 2 year period, we made about 50% returns, about 25% per year. So I was very happy with that. And it was a great project, and the first time that Peter and I partnered together on anything. Peter, do you want to add a little more color to this project?
Yeah, I'll say, Matt, I think certainly real estate's the consummate team sport. And in that case, with the onset of COVID and ultimately some of the changes in the market environment following that onset, Matt can attest to this better than anyone as an investor in that deal. We were extremely transparent and forthcoming with both the adaptations we made to our business strategy and plan at the time and how we were viewing the market and the risks of waiting or otherwise choosing to exit at that point in time. One of the core underpinnings of our business plan strategy is to ensure we are embedding optionality into the life cycle of our view of how a deal could go. These projects typically have very long life cycles and are subject to forces that are beyond the control of any of the sponsors or investors in that deal. And so for us, having contingencies is really important. And in this case, the site was extremely challenging from a technical perspective. There were a lot of geotechnical issues, significant environmental issues that needed to be overcome in order for the site to be transactable. And we really focused a lot of our energy and attention on resolving those issues early in the process so that we could transact if and when we either needed or otherwise determined it would be appropriate to do so. And we all worked together and collaboratively ultimately to get to that place, and had a good outcome as a result. And in fact, I just passed that building this afternoon. It's been completed. Greystar delivered it. It's doing extremely well in that submarket, and it's nice to see that in the marketplace. So
Yeah. And you want to talk about some of the projects that you've done with Common Water?
sure. So I mentioned earlier that we have over $500 million in full cycle experience. We started the company back in 2017 and have focused on doing only a handful of transactions per year. Ultimately, a lot of the investment capital we've had to date has been either individual ultra high net worth investors or family offices. On the back of several of those exits in our first vintage of deals, we formed a GP real estate fund in 2022 and have carried that forward with the other projects that we're bringing vertical, including this one right now. Granite Woods Commerce Center is our focus. Sora in the lower right-hand corner just received its certificate of occupancy this past Friday. It was 32% pre-leased at the time of CO, so we were happily watching move-ins over the weekend, and everyone is very excited to be moving into their new units there. The building looks great. We're extremely excited about how that building turned out, and so we're timed perfectly here and ready to transition the construction management team and the focus of our development team onto Granite Woods as we go vertical with that project.
Awesome. And here is a partial look at my portfolio. I focus primarily on multifamily. And as you can see, most of the projects have been in Texas, although we have Kansas represented here, Missouri, Atlanta, Georgia, and also a new construction project that we're working on in Ottawa, Canada. So that's just a handful of some of the projects that I've been involved in. And Peter, do you want to tell everyone a little bit about ARCO?
Sure. So as we moved into the industrial space, one of the things that we felt would be important is aligning with an industry leader on the execution side of the process. So at the time where we engaged ARCO here, they were not really present in the Northeast. They were mostly in sort of the central and southern markets throughout the U.S. As you can see, they have over 4,000 of these projects they've completed in 450 cities since 1992. They're a very substantial contractor throughout the U.S. One of the key advantages that they bring here is their purchasing power as a result of their scale and reach, which is allowing us to deliver this building at a competitive basis. They're also extremely efficient in their construction methodologies and processes. So the total execution timeline for 100,000 square feet here, the vertical construction is 6 months. As you're thinking about the timeline and investment horizon on this first phase, between the work that's been completed to date and then ultimately that truncated delivery timeline, it's a very efficient process moving forward, and their team has been fantastic to work with throughout.
Great.
So we'll turn it over to Barak to talk about the highlights of the investment.
Yes. So, when you talk about commercial investment, there's the team, there's the location, and there's the deal. All three of them I like, and I'm very excited about. The team speaks for itself. We just introduced them. Their location is at Hooksett, New Hampshire. Very, very strategically located, about 15 minutes from Manchester Airport, 50 minutes from Boston Logan Airport, 1,500 feet from I-93. Very accessible, very strategic. Also, the location, the supply and demand forces are really playing in our favor. We feel over 10 million square feet of space has been taken out of the market and converted to residential and other things. So there's and whatever is left is pretty old. So there's a lot of opportunity for a Class A new construction, like what we are proposing. Now, the deal itself, as Peter already talked about, a lot of the risk has been taken out of this because the team has been doing so much work over the last 5 years, investing $17 million and doing the entitlements, the zoning, the permits, the infrastructure, all that work that takes so much time and adds so much risk, during which time the market can shift 7 times. This is all being done already, and we are ready to hit the ground basically in September. Between that and the great construction company that we have also a very competitive construction loan in place. And the returns to investors are very, very attractive. So again, pretty simple construction as well, with a great construction company that should take 6 months. Overall hold for the project is 25 months. This slide is showing you 60% financing, 8.5% interest rates, 24% interest only, additional term, another 12 months if we need it. Optionality is great between finding a tenant. We're underwriting this deal at $14.5 per square foot. That's pretty conservative given the comps, which we'll talk about a little bit later. And the option to sell the 100,000 square feet, the option to refinance, the option to sell it maybe in conjunction with a built or not built additional 400 square feet, gives us a lot of flexibility, a lot of optionality. And returns that are offered to our investors, I think, are quite attractive. So that's why I'm very excited.
Awesome. And Yasser, you want to tell us about the location?
Yeah, so the location is another one of the attractive components of this whole thing. So for those of you outside of the New England area, it's important to understand a little bit of the dynamics. So you have Boston, which is a major metropolitan area, but it's quite landlocked. On one edge you have the ocean, and you have a very, very mature market. So from an industrial perspective, initially, since it's so mature, it's already been quite built up. Interesting trends are, since 2014, there's been a big shift out of industrial space and into obligatory residential space because of the population demographics and all that. So as industry has kind of revved back up in the preceding 5 to 7 years, initially the construction went westward and to the south of Boston, but those markets have since matured, and with that the rents it became quite cost prohibitive. So the next corridor was going north, and that's exactly where we're positioned. So the key concepts, and you see that on your screen as the star there, is that it's literally a stone's throw away. It's about 1,500 feet from I-93, which is, again, one of the major kind of veins into northern Boston. But most importantly as well, it's very, very close to two major airports. One is Boston, Manchester Regional, and then you also have Boston Logan. These are high volume airports in themselves. So Manchester, Boston, about 14 miles from the site of Commerce Center. You're talking about four major cargo carriers. You're talking well over 230 million pounds of cargo going in and out, commercial airlines, and then 1.3 million passengers. So, delineated over here is, again, just to kind of depict, it's literally right on I-93. So, again, whether by air, by truck, and so on, huge advantages in a very booming corridor. And this is just for reference. On the left of the screen is south, and to the right of the screen is north. But that's kind of showing you, Hooksett, New Hampshire there, and kind of a lot of major players in the area, household names such as Target, Amazon, and so on and so forth.
So looking at the market, as everyone's been saying, there's an abundance of demand, right? There's 33 million square feet of active demand for industrial space. Now, in the past 12 years, we've seen close to 11 million square feet disappear, actually get repurposed from industrial, moved into life sciences, residential, anything but industrial. So as Yasser mentioned, things have been moving to the west, things have been moving to the south, and now it's moving decisively north. And, we have basically a 3.5x multiple here of demand versus what's actually available for people to use. And so, this is showing how constrained it is and what's been happening. If you look on the right here, you can also see the trend going from Everett, right, just north of the city, and just going up and up and up and moving towards New Hampshire. That's what we're seeing. That's where there has really been a huge amount of demand and a huge amount of growth. Now, southern New Hampshire, which used to only be overflow from Boston, has really become a market of its own because of all these shifts that we're seeing. When you look at the vacancy rate in 2019 of 12%, and then you see that in 2024, it went down to 6.2%. That is a very clear demonstration of the growth in that market and the demand in that market. If you look on the right of that chart, you can see the shortage of 100K plus square foot availabilities. There's only one in southern New Hampshire, 10 in the Metro West, and 15 in the core. So, it's no longer just that backup market. It is a primary market. Vacancy rates have dropped significantly, and there's a very limited supply of other options out there in southern New Hampshire. When we look at the demographics of New Hampshire, we can see within the 25, 50, and even 100-mile radius from the property, strong population, up to 20 million in that 100-mile, and all the household income is, above $110,000. So, good areas with good income, but most importantly is on the right, those local industrial users, where you see some of the most notable names, the United States Postal Service, FedEx, Amazon, Target. I mean, there's just lots and lots of industrial users in the area because it's needed and wanted, and it's growing more and more. They were ranked number 3 in the top 10 inbound states in the U.S., trailing only Maine and North Carolina. So that increase, that lower vacancy, has also pushed rents up. Back in 2016, industrial properties, warehouse distribution properties, were going for about $6.41 per square foot. Now, from 2016 to 2022, you can see how it's gone up, and especially a big jump from about 2020 at 977 up to 1429 in 2022. And that's where this chart ends. But when we look at what's going on right now, average market rent in Q2 of this year was over $15. $15.22 per square foot on a triple net lease. Okay. We've underwritten $14.50. We want to be conservative. And there's a matrix a little bit later that will walk you through with the financials to show you how the rent could play a factor on the total return when we exit the property. But when we're looking at what's going on with the demographics, look, there is some end user requirements that fall basically into two categories. There's people who need, the 400, square foot property, 150 to 400 square foot, right? These are large users who are going to need something big. We've talked with a number who are very interested in our project, and another 300 square foot user is just about to sign another 10 to 15 year lease with a direct competitor. We're also tracking 6 different small user requirements who are looking for something between maybe 50 to 130 square feet. And, they are all primarily warehouse, with one of them having a manufacturing component. But when we look at what is going on, we look at the comps from the past 12 months in Portsmouth, Salem, and Londonderry, nearby towns, we can see leases that are getting signed anywhere from 5 to 10 and a half years. And the price per square foot is as low as 15. And we have 2 comps that are at 1650. Again, we underwrote 1450. So we feel very strongly with our comps. And, we have specific things in terms of like water usage and power that Peter will talk about in a minute that are superior, that make this I think an even more superior property than what these leases are being signed with. So with that, Peter, you want to take us into the property overview?
Yeah, happy to, Matt. And one other thing I'll add to the market itself is you'll recall there was a pie chart that we just looked at that described the total composition of supply in the marketplace. Yeah, exactly. And you'll see that 12 million of that 29.8 million is proposed, and then another 815,000 is permitted. And then if Matt, you go back to the slide that talks about some of the tenants in the marketplace. Put down one more here. One more. And then the next one, I think it is. Yep, here. So there's a note here about users who are focused on existing buildings. One of the questions we get often is, do you have a lease in place today? And for the reason that many projects in the Northeast in particular describe themselves as being shovel ready or otherwise approved in their marketing, but are otherwise nowhere near ready to start construction. Many users and tenants in this market will not enter into a lease or even tour a site without vertical improvements on the site. It is not historically a pre-leasing market or a pre-sale market in that regard. And it is critically important to the business plan that we advance the vertical construction in order to enter into a lease ultimately with an end user. There have been several leases of 100,000 square feet that have been executed in the last few months over the first and second quarter of this year, for which we were on the survey and would have been active contenders had we had vertical improvements completed. Now, those leases have had the effect of reducing the competitive supply in southern New Hampshire and further isolating this property as an attractive option to users moving forward. But it just remains the point that as if you choose to do your own research on the market and the demographics therein, when you see certain listings for certain properties on LoopNet or through other brokerage communications in the marketplace, often the challenge is determining what is ready to advance and what is not. And our property is very uniquely positioned in that regard, that we are truly and accurately shovel ready. So Matt, as we move ahead now and talk about the property itself, What this shows in this rendering, and you'll see I-93 is the roadway that's visible just to the northeast of the building in this image. And we're currently sort of hovering over the southwest corner facing northeast toward the highway. This would be the building in its fully developed state, over 500 total thousand square feet. Again, this specific opportunity is isolated to the first 100,000 square feet, which will be starting at the north end of the property. We have the ability to develop the remaining phase as a standalone building or as a connected building and contiguous with the first 100,000 square feet. There is tremendous flexibility in the approvals that we accomplished here with the town. And since 2020, we've done a handful of things that are really important to note. We've accomplished all discretionary approvals at the local, state, and federal level, including the removal of 2 wetlands that were previously in the center of the industrial portion of the site. We've also accomplished a use variance to allow for the creation of industrial on this property. It wasn't previously zoned to allow that. We've relocated the Eversource transmission lines that were formerly running through the center of the property and entered into a joint use agreement with Eversource to allow us to construct the improvements, which do partially live within their right-of-way. We've relocated the access easement to the site, so we have a dedicated access to Hackett Hill Road, specific for our property. We have enabled the utilities to the property. So when we started, there was no municipal water or sewer available to the site. We've since completed over 3 miles of horizontal infrastructure, including a 30-foot deep pump station to connect to an existing sewer main adjacent to the Merrimack River, which bring municipal water and sewer to the site. From a utility standpoint, you'll hear our references to utilities. The site has the ability today to deliver 20,000 amps of power to an end user. And to help you understand the baseline in the marketplace, when we started this project, 2020, the prevailing power requirement by end users and supplied by competitive properties was 2,000 amps. That escalated to 3,500 amps right around 2022, and is currently at about 4,500 amps is really the minimum threshold you would expect a property to be capable of providing in order to attract a logistics or a warehousing user. The higher end non-nuisance manufacturing companies do have significantly greater power requirements that typically range between 15 and 18,000 amps. So being able to provide that type of power does allow this property to stand out among a wider group of potential users. We also have the ability to supply up to 1.2 million gallons of water per day to the site, which makes it attractive to bottling companies and food processing companies that have difficulty finding or securing that type of access to water. And from a sewer and gas perspective, there's significant capacity here as well, both of which are extremely competitive for a very wide number of users throughout the market. Our loan, as Barak mentioned earlier, we received our appraisal back yesterday, which met and exceeded the value tests that the construction lender was looking to confirm prior to issuing the formal commitment letter for the loan. So we are in a commitment phase now with the lender and advancing to documents next week with that lender and on track to close that loan on or around August 20th, which is our targeted closing date to that. So as you'll see in the photo here, all of the horizontal pad preparation work is complete. We've completed the ground improvements. We've taken virtually all of the risk out of the horizontal construction and the infrastructure construction on site. And when you look at industrial development in particular, the vertical construction is very defined and specific. It's a very straightforward building program. There is a risk of ultimately with these projects of compounding errors due to just the sheer scale and volume. So tolerances are extremely tight in vertical construction, but the costs are very well defined. When we look at floor flatness, for example, as a key specification that we have to meet or exceed in order to qualify as Class A, the threshold specification of floor flatness of 50, which is the benchmark ASTM measurement that we use, requires a substantial amount of preparation to the site in order to ensure that over a 10 to 15 year span, there is less than 1 inch of differential movement on that slab across a building that could be 250 feet wide by 2,000 feet long, right? So, that's a significant amount of settlement to mitigate in the earthwork phase of the project. It's something that we have completed and completely de-risked for this property. So you're coming into the project at a time where a lot of those cost drivers have been quantified and completed, to the extent that our forward-looking cost drivers are very defined and would be executed under a lump sum contract with ARCO in order to further reduce any form of cost exposure to the project during that vertical execution phase.
And all the entitlements and permits are in place, correct? Yeah. So here's some renderings of what the project will look like when completed. This one we've seen. Here's a view of it as you would be driving on I-93. You can see how close it is to the highway. So Peter, you want to run? Actually, I can kick off this slide. This is similar to what we saw in the first slide of the presentation. Our project budget is almost 21 million. We need about 8.5 in equity. We're going to hold it for 25 months with a reversion cap rate of 5.5. We're looking at an equity multiple of 1.57 and an internal rate of return of over 28%, getting close to 29%. Now, the way that this works is the numbers that you're seeing here, like the equity multiple and the IRR, this is two LPs after all fees and everything is taken care of. So this is this is what we anticipate as your final amount received as an investor. What we will be doing is we will be giving an 8% preferred return to investors. So what that means is in each year of the project, investors would get 8% return on their investment before the sponsorship group would see anything. Now, the sponsorship group, in terms of what we would see, what our percentages would be, it changes. We'll go through it. It's a 5-tier IRR-driven waterfall, meaning the better the deal performs, the more that the investor, that the sponsorship team will get, because we're making more and more money for investors. There is a 1% acquisition fee. It is not based on the project budget. It's based on the cost basis of the property. There would be a 3% asset management fee and a 4% development fee, which are both very standard for the industry. And we will not be taking any disposition or refinance fees. Peter, do you want to walk us through the sources and uses?
Sure. And just to clarify on that point, Matt, on the cost basis, to date, just using ballpark numbers, we've attributed roughly $5.9 million worth of costs to the first phase of the work that was accomplished for the project as a whole. And that's either on a per acre or a per square foot pro rata basis, depending on the budget line item. So allocated in accordance with the overall plan for the property and allocated evenly across those pieces. So there hasn't been any artificial cost loading to phase one. That transfer of the first phase of the project into the special purpose entity for the development of this 100,000 square feet is happening at par. So we're not taking a step up on land basis or any of the work that's been done to date. We're simply bringing that deal over at par, given our ongoing and continued investment as well in the project and in this property. And so as we look at the first phase here, what we're seeing is the breakdown of sources and uses. At top, we have our uses here, which the land acquisition costs are specifically the pro rata share of the costs to acquire the site in its unimproved phase and state, which is based on what we paid to acquire the site from a former owner. We then have site costs, which encompass your grading, earthwork, stormwater prep, your infrastructure work on the site itself. You'll see an offsite construction line item, which is then broken out. That's specific to the offsite water and sewer improvements, all of which were completed under a TIF agreement with the town of Hooksett. which provides for the reimbursement of 60% of annual property taxes annually over a 15-year period, which is an additional stream of cash to the property, which we'll talk about shortly. We then have our hard costs, which are specific to remaining site and vertical construction costs, and then soft costs, which are, again, all inclusive of those professional fees to architects and engineers, civil engineers, consultants throughout the permitting and entitlements phase. And then below that, leasing commissions, which would be due and payable upon execution of a lease to a leasing broker, a TI allowance, which is a specific set aside for any interior improvements that we can use as a negotiating tool during lease discussions, and exclude the cost of a demising wall, which is carried in the hard costs item up above. We've also carried costs for installation of all of our dock packages on day one, and the inclusion of knockout panels for additional dock packages if they're required by a tenant. So our actual effective TI allowance that we're carrying in this project is closer to $6 a foot, which is conservative by market standards for leases of this type of scale. Our financing costs, construction loan interest reserve, and then an operating deficit, which will carry us through the lease-up period on the back end of delivery for the project. And from a use perspective, we've talked about the construction loan at 60%, and then the remainder split between limited partner equity and then general partner equity, all of which the general partner equity has been funded to date into the deal and will remain in the deal.
And we'll be putting additional into that as well.
And as far as assumptions are concerned, what we're looking here, again, Matt and others here had alluded to the 1450 base triple net rent assumption inbound for the project. Contractual rent increases of 2%, which from a market perspective are actually currently at 3% annual bumps is what we're seeing in most leases that are getting executed. Some other income growth, both whether it's from solar, the TIF agreement, or a combination of those two. We're accounting for some operating expense growth, which is extremely limited. Again, this is a triple net lease structure, so that the tenant is paying taxes, other operating expenses on the property, out of their side of the ledger. So it's a very light operational expense load, which we'll see as we get it to the P&L. And then any other sort of vacancy assumptions and closing costs built into that. You can see the total project level levered IRRs, equity multiple, and net profit below that at 39.5%, 1.8x, and 6.7 million. And off to the right, you see our assumptions for the construction loan, which are driven by the actual terms we have from the lender. Permanent loan assumptions. So the construction loan includes that extension period as well. If we chose not to refinance the loan immediately upon stabilization and to stay with our current lender, we have the option to do that inside of what's referred to as a mini perm phase of that loan. And during that period, we can refinance it with another lender, we can refinance it with the same lender, or we could ultimately choose to exit and sell the property. But for the purposes of the analysis, we built in some assumptions on what a permanent loan would look like in the event of a refinance. And then we've assumed the income as well from the TIF agreement, which triggers disbursements to the property starting annually on April 1st, following the receipt of a certificate of occupancy for the property. And again, that reimbursement is 60% of annual property taxes paid by the property to the municipality.
So to talk about the waterfall that we talked about earlier, right? How the split between limited partners and general partners works. I want to direct you towards the bottom of the screen where we detail it. There is the preferred return that we talked about, an 8% preferred return. Investors would get that preferred return and the return of their capital before the general partners will see a dime. Okay, so that's what happens. That's the first tier. Now, once the IRR has gotten to 8% or larger, that then from 8% on, would be a 90-10 split, with 90% of the profits going to the partners, the limited partners, the investors in the deal, and 10% going to this general partnership team. Once the IRR gets to 14% return, it goes to an 80-20 split. Once we have an IRR that goes up to 18%, we're talking about a 65-35 split from 18% up to 22. And any IRR above 22%, we would split 50-50 between the LPs and the GPs. So you can see general partners on the earlier stages of just getting the return or smaller profits. We don't really see. I mean, we do get a return, but not as large as if we can really make this property perform exceptionally well. We will essentially get a bonus, right, for that additional work, for great profits to investors. This is a final analysis of the project. Peter, do you want to walk us through this and show them specifically, I think, down on the right-hand side here, what these numbers are?
Sure. So quickly, just on the left, this is a further breakdown of the budget we looked at previously in the sources and uses slide. The middle column, you'll see our accounting for the costs that have been spent to date, totaling the $5.9 million in basis at which the project is being acquired by the SPE for this phase. And so you can understand how that allocates across those items, and then ultimately what's left to spend for the remainder of the budget to execute the project. And so on the right-hand side is a summary, again, of the total project costs, so that $20,827,079. What's been completed to date, which is that $5,961,434, and then the as-is appraisal. So recently we had the property appraised for the construction loan, and the current state of the property with no additional work has the value at $6.5 million in today's environment. So we're entering at a slightly below market value from an appraisal perspective to start this phase, and giving ourselves some additional room to absorb, again, any risks or other unforeseens that may come to bear as we move through the construction and lease-up phase of the project. And from a P&L perspective, I mentioned this is a triple net rent. So the tenant is carrying a very significant portion of the forward costs on the property post-occupancy. That $1,450 rent amounts to an annual gross income of $1.45 million across the property. There's a TIF real estate tax reimbursement we're assuming of $108,000 annually, just for underwriting purposes. That could be more or less depending on the amount of actual property tax paid during the operating period of the project, as well as some solar income through a power purchase agreement. The structure of the building is sized to accommodate the future installation of solar on the roof of the building. It's something that we've been tracking carefully. We were advised by our leasing broker to pause on entering into any form of an agreement with a solar array company to construct those improvements or lease the rooftop for those improvements until we have secured a lease and understood any HVAC requirements or other rooftop requirements for a building user, so that those two leases are not in conflict. But it is part of our business plan to go out and ultimately lease the available square footage on the roof to a solar company, and ultimately to derive income through a power purchase agreement. In doing so, the management fees, you can see at 3% on the numbers we're talking about here, is less than $50,000 a year. Ultimately to asset manage the property during the operations phase. We've set aside a partnership cost reserve as well for total operating expenses, which are a very small fraction of the total income for the property, to leave us with an NOI assumption of $1,481,242. And you can see below just some of the analysis of the math that we've done on the taxes as well, which is a summary of a much more detailed analysis in order to size the prospective income through the TIF reimbursement. The average lease term right now in the market is roughly 8 years. We're assuming approximately 5% in leasing commission fees due to the leasing broker at the time of execution, And ultimately, the value of those and number is going to change based on the ultimate duration of the lease that we're entering into, and it's calculated on the total value of that lease. So any movement in those types of numbers will be correlated to an increase or decrease in the total value of the lease itself. So from a cost and risk perspective, those do move in tandem on a project like this.
So this is a sensitivity analysis that you'll see at the top. I love showing these when we have investment opportunities because, as we said in the disclaimers, right, we're doing our best to look peer into our crystal ball and see where things are going to go, but there's no guarantees, and so I want investors to be able to have an understanding of where things could go. So, our baseline for the project is a 5.5 exit cap. That is the cap rate prevailing in the market today. And as we talked about, so that's what you see the cap rates going here. As cap rates go down, it means that values go up. So here you see these cap rates are going up. It means the valuation of the property is going down. And then we have base rents here. As we talked about, the base rents now in the market are, overall, we're talking about close to 1550, and we saw those 12-month leases. We saw a number of them anywhere from 16 up to 1650. But we're assuming 1450. So if we look at this matrix and we say, okay, we're going to say that our rents are 6.1% below the current market average, but that our exit cap rate is at the market average. That's what we've underwritten for, that 28.7% IRR. Now, let's say we end up leasing the property at 1550 a square foot, but cap rates stay where they are. Well, that would mean 33.8% IRR. Maybe cap rates compress. We can get it at 37.6. Maybe cap rates expand. If they expanded a full 100 basis points, which would be a sizable expansion, we would be looking at 19.5. So the only scenario in this matrix in which we do lose money is if we were to see rents go all the way down to $12.50 a square foot, and in conjunction with that, we saw the exit cap rates expand by 100 basis points, then we would lose money on the project. But in every other case, we're in good shape, and in most cases, we're above, 10. There's only 1, 2, 3, 4 scenarios where we're under 10% return, and a number of scenarios in which we're over 20%. So we feel very, very strongly about this, and have really tried to show more of the downside than the upside, but there could be further upside depending on where things go. So that's that matrix. As Peter had mentioned, there is a TIF agreement in place on this property, allowing annual reimbursement of up to 60% of the incremental property taxes on an annual basis over a 15-year period. Now, that would be basically cash flow to us as investors, because these are triple net leases. That is customary in the market. So the tenants would be paying property taxes. The taxes are not reduced, but there's a reimbursement. So that reimbursement will come to the property owner. If we were to sell the property, depending on the terms of the sale, it is very likely that they would, the new ownership would receive that reimbursement, but we would be able to get, I think, a little bit more on our sales price, with them understanding that they're going to be getting that reimbursement. So that's a fantastic thing for us to have. In addition to that, we are going to be working closely with our CPA to ensure that this investment, like we do with all of them, are as tax efficient as possible. There is new legislation that you may have heard about with the new One Big Beautiful Bill. There's a new 168N deduction. And, when these new laws come out and new legislation, sometimes there needs to be some clarity around it. So we're not fully 100% clear on this, and we're working with our CPA firm to understand. There could be an enormous tax benefit. There is talk about this deduction affecting manufacturing and warehouse and distributions. We have to see how it works with a new construction, with us leasing it out. It might go directly to a tenant. We'll have to work through it. I want you to understand that these potential benefit that we have here is not included in our underwriting. So if we get some sort of deduction from this, that would be wonderful. It's icing on the cake, but we have not underwritten for any tax savings from this. And I want to explain also the way that we're structuring this deal. So we've created two entities. So the first entity is the Granite Woods Phase 1 Special Purpose Entity, LLC. Okay. This LLC is the LLC that is going to own Phase 1. And there will be members of that entity and managers. So the members of the entity will be in two classes, Class A and Class B. Class A is investors. That includes everyone that is watching this right now who's potentially thinking about investing in the deal. It also includes the upwards of $3 million that the sponsorship team is putting in to invest into this deal. And then there is also Class B. Now, this is the sponsors' waterfall that we talked about with the nothing until 8%, and then the 90-10 split until 14%, so on and so forth. That's where those Class B shares come in. And then in terms of the management of this entity, that is being done by another entity, GW Phase 1 SPE MGR for manager. And the members and managers of this entity are the four of us tonight, myself, Barak, Peter, and Yasser. So our timeline for the project is Phase 1. We are looking to commence vertical construction. We would like to have all the funding in and close on the loan by August 20th. Then we would start the construction. It's a 6-month construction. It would be completed in Q1 of 2026. And then we would be looking to refinance the property about a year to a year and a half later. Keep in mind, there is a prepayment penalty on the loan if we exit the loan in the first 18 months. So we would look to keep the property keep the loan in place for at least 18 months. But soon thereafter, if we have a tenant in place and they've been there for a little while and it's seasoned and the lender feels comfortable with it, we would refinance as quickly as possible. And that is what this investment is for. Now, there is going to be, in most cases, we believe, a Phase 2. So we would refinance or sell the property in 2027. A sale would mean that we were selling Phase 1 most likely with the rest of the land. Okay. If we were to refinance, what would most likely happen is we would refinance our property and we would continue with the Phase 2 of the project. I just want to be really clear. Phase 2 is a separate investment. It is not this investment. Phase 2 hasn't been created yet. There's the land there. We have all the costs and everything. But if we were to move forward with the Phase 2, we would bring that out for investment. There is a chance that some large institutional investor might want to do it, but in most cases, we would be going back out to investors like yourself. Obviously, if you're investing in Phase 1, we're going to give you a first crack at the nut if we're going out to investors on this to invest in Phase 2, which would commence in Q2 of 2027. The core and the shell would be complete by the end of fourth quarter. And we would look to lease it up and have it completely leased up by Q4 of 2028, at which point we would refinance and then do a sale 2 years later. So now there are many scenarios where, maybe we sell it before that, maybe we sell it in 2028. But the business plan, the way that we've underwritten it, we're looking that we would go for a sale in 2030. So the next steps for the investment. All the legal documents are available now through Cardia's portal. So investors should go read, understand the PPM and the documents. If you're planning on investing in this through your IRA, you can, if you have a self-directed IRA, but you have to start immediately. It takes a while for funds to get moved and for paperwork to get approved by SDIRA custodians. So, I mean, if this is something that you want to do and you want to do it through an SDIRA, you really should be on the phone with your custodian tomorrow morning to get things rolling, because it will take probably a couple of weeks to get that done. Submit all of the documents to the portal for approval, and we're expecting to close on the loan and want to have all the funds because we're not going to be able to close on the loan until we have all the funds in the bank account on August 20th, 2025. So that's the funding deadline is August 20th, 2025. The minimum investment for this deal is $100,000, and that could be cash or an IRA or some combination. It will be filled on a first come first served order, and preference will be given to higher amounts that have the funds wired to the investment bank account. Our soft commit at this time has already surpassed our equity raise target. And we have a family office that has indicated interest of putting in $2 million. We have a lot of other interested parties from smaller checks to larger checks. And so I don't think everyone's gonna commit, but those soft commits are there. And so I would say that if this is something that you're interested in, to move sooner rather than later. We will send out an email as soon as we reach the equity raise threshold. As a matter of fact, we will send out an email once we get to maybe 70, 75, 80%, somewhere around there, to just let you know, hey, we're closing in now. So we will send out an email about that, and then another one once we're done. So it's a simple 6-step process. Log into Cardia's investor portal. I know Yasser's sending out an email with a link to this later, but it's cardiarei.cashflowportal.com. Click on the new offerings from the menu on the left and click on the green invest button on the upper right of the portfolio page and enter your investment details. Read and electronically sign the legal documents. So the legal documents that we have involved here are a private placement memorandum, a subscription agreement, the operating agreement, and an investor questionnaire. There's not, I'm sorry, it says ACH agreement. That's my fault. It shouldn't say that. There's no ACH agreement in here. You'll also receive an email with instructions on how to verify your accredited status. So we'll talk about that in 1 second. You'll wait for review and approval of the documents via email and with wire instructions. And you should call Yasser on the phone to confirm the wire information. Make sure that the bank account information is correct. By the way, it's a Chase bank account, okay? Make sure you're sending your money to Chase Bank. There's a lot of wire fraud that happen. We have never had it happen, but title companies just throughout the country have seen wire fraud where someone will intercept emails and change account numbers and things like that. So just make sure you call Yasser, get a verbal indication from him on the phone of what the account number and routing number, and then we'll hold your spot for 72 hours. We are anticipating that we're going to go on a wait list here because of the strong indication of people interested in this. So we're happy to hold your spot, but if 3 days go by, you've signed all the paperwork, but there's not a wire coming through, let us know what's going on, or we're going to have to open it up to anybody who might be waiting. So about the accredited investor verification, there is a really easy way to do. There's 3 options, but option 1 is the easiest. As you're going through the portal and you're filling out, you're going to review all the legal documents electronically and sign them electronically. At the end of that, there will be a page and there's a button that you can click on to use a third party called Parallel Markets. Parallel Markets is a separate company. You can look them up. We have no affiliation with them whatsoever. They will review your financial statements and verify your status as a accredited investor. And we, as a sponsorship group, we will cover the cost of that verification. So it doesn't cost you anything, and our team has no visibility whatsoever into any of the documentation provided. We just get the results. We get that accredited letter verification. Now, for some reason, you're opposed to doing that, and I really think it's the easiest, most streamlined way to do it. There is an option where you could reach out to Yasser. He'll send you an affidavit that you can have signed by your CPA or an attorney or an investment advisor that's registered with the SEC or a registered broker-dealer, okay? But it can't just be like a regular accountant. It has to be a CPA. So that's the second option. Or the third option is if you already have a verified investor accreditation certificate, or, one of these affidavits are from a company like Parallel Markets that you've obtained in the last 90 days, you can send it to us. They're only good for 90 days. Once we have it in our system, by the way, you're verified for 5 years, but the SEC will only allow us to accept this if it's obtained within the previous 90 days. So that's about it for the webinar tonight. I'll turn it back over to Yasser, and we're going to open it up to Q&A if people have questions that they'd like to ask about the project.
Yeah, so thank you, Matt. I mean, that was fantastic. And thanks to everyone for joining us, out of respect for your time there. We just wanted to make this as smooth and easy as a process. So this is my information, cell phone, email. So, any questions during this process, more than happy to help. If you guys have any questions now, you can either type them in right now, or you can that's my email. You can email it. And we could always, send it out also to the rest of the group, because if you have a question, it's likely that more than, someone else does as well. So.
Did we do such a good job that there's no questions?
I think so, Matt. I think.
Okay.
All right, guys. Well, again, thanks for your time. Thanks to our panelists here as well. Yeah, look forward to collaborating. Okay. So anything, don't be shy. You can reach out. Otherwise, we'll be talking soon. All right. Have a good night.
Good night.